Banks are feeling anything but stressed today.
Right. Are they up again? Are the banks up again?
They're up pretty big. I mean, you've seen some big moves in stocks. JP Morgan's up pretty strong. Bank of America, last time I looked, I think it was up about 4%. Morgan Stanley up about 4%.
What about Citi's? Even Citi up?
Citi, I think, was up as well today after they took a little bit of a beating yesterday.
Now, the stress tests came out again, and this time there wasn't as much trumpeting and fanfare as last time we heard about them. Now, what did they come out and say again?
Well, I think generally, the test came out and said, balance sheets are strong. You don't have to worry as much. And for investors, the big message also was the Fed was saying, we're not going to stand in the way of capital returns. Banks don't have to hoard capital. So that was a very bullish sign for banks. The second bullish sign in this, and it's sort of the Fed, but not the Fed, is something you were just talking about with Mike Santoli, which is what's happening in yields. Because if you think about this, and I wrote a piece about this a few weeks ago, on the one hand, if the Fed says the stress test, okay, pretty much all clear, that's great. But on the other hand, you still have the Fed has the zero interest rate policy, which is a really strong headwind for the big banks. But now, if you're seeing the yields rise, if you're seeing steepening in the curve, that's really good for banks. So you're sort of getting a combo here.
Right. Now, is there a risk that some of the banks could get caught flat-footed in terms of their treasury holdings? I mean, my guess is most of them carry very short-term paper. But is there a chance that any of the big banks are sitting on longer-dated paper? Is some kind of...
I mean, never say never, but the feeling you get from looking at the durations they report, the size of the treasury holdings, and more importantly, I think, is you look at the net interest margins they've been reporting, pretty anemic for the biggest banks. And what that shows you is these guys are really crowded in and shorter duration paper. I don't think any of them has been sitting there past couple months saying, you know what, let's go buy some 30-year paper. Let's go to long bond. Also, keep in mind, 2 years ago, even though they were horribly early and horribly wrong, the regulators said to the banks, you guys better all be prepared for a turn in the rate cycle. Now, of course, that was terrible advice, but if you're, Jamie Dimon or Vikram Pandit, and 7 of the regulators say be prepared, you're not going to say, oh, well, forget about them. I'll just go take a chance.
Let's talk about just bank stocks in general. I mean, the valuations have come up. I'm only down like, I don't know, 25% in my XLF now, and not even now, maybe 20%, which never.
Where's your starting point on that?
Oh, my XLF is around 20. It's like it's 16 now, something like that, right?
I don't think people say who owned Citi in 2005 are feeling the same way.
No, they're not.
They're still down 98%.
Yeah, I'm not down. But is there still value in them? Quick answer.
I think there's still value, but it's going to depend what happens with interest rates. Are we starting to see the cycle? Is there a turn at hand? But the big question is going to be, as rates rise, what does that do to mortgage rates? And then how does the Fed react to that?
And does it choke off any recovery? David Reilly, heard on the street, thank you very much.